Dear professional students, you are welcome to another section under fixed income valuation and analysis. And in this session, we want to look at the risk measurement. And to start with, risk management is one of the crucial processes that is being used to make investment decisions. So the process involves identifying and analyzing the amount of risk involved in an investment, and either accepting that risk or mitigating it. Some of these common measures of risk include standard deviation, beta, value at risk, and conditional value at risk. Let's start from the first one, the standard deviation. Standard deviation measures the dispersion of data from its expected value. That is what standard deviation measures. Is when something is at variance. You want to know level of variability of certain data from the expected value. The expected value is the mean. You want to know how the data are actually dispersed away from what? From the average, with the center. So the standard deviation is used in making an investment decision to measure the amount of historical volatility associated with an investment relative to the annual rate of return. This concept, that is standard deviation, also indicates how much the current return is deviating from the expected historical normal returns. For example, a stock with high standard deviation experiences high volatility and therefore a higher level of risk associated with the stock. So when the standard deviation is high, it means there is high volatility, and volatility is about the risk which is associated with that stock. That's about standard deviation. And for those that are interested only in potential losses while ignoring possible gains, the semi-deviation essentially only look at the standard deviation to the downside. To the what? To the downside. If you are only interested in the potential losses while ignoring the possible gain. Understand? If you lost, you only loss. So the semi-deviation essentially look at what? Only look at the standard deviation to the downside. And what is semi-deviation? Because whenever we say something, we have to clarify it. Now, I made mention of semi-deviation. Semi-deviation. So, semi-deviation by meaning is a method of measuring the below mean fluctuation in the return on investment. It's used to measure what? It is used to measure the below mean fluctuation in the return on investment. That is what it means. And this semi-deviation reflects the worst case performance to be expected from the risky asset. I mean, this semi-deviation is an alternative measurement to standard deviation or variance. And unlike those measures, semi-deviation looks at the negative price fluctuation. That is why it said those below mean. No, for mean is the average. So those income that below mean is negative. So we want to look at the negative price fluctuation. As a result, is the most often used to evaluate the down risk of an investment. Understand? So that is a semi-deviation. So semi-deviation is used to measure the dispersion of an asset price from an unobserved mean or target value. So the one that is above the mean, you not bother. But one that is below the mean that will give you negative is where you look at the dispersion from it. So in this sense, dispersion means the extent of variation from the mean price. So that is a mean deviation. And where we are coming from, which is a standard deviation, we said for those that are interested only in the potential losses while ignoring the possible gain. No, those ones that are above the mean, they are the gain. For the one that are below the mean, they are the losses. So if one is interested in losses and not the gain, so is it the mean deviation that we look into? Because it's the mean deviation that try to consider the below mean fluctuation in the investment, or in the return, or on the return on investment. So that's about standard deviation. What we use to know is to find the dispersion from the average or the expected value. Now the next one is SAP ratio. Another risk measurement is what? Is SAP ratio. And SAP ratio measures the performance as adjusted by the associated risk. The performance has done what? As adjusted by the associated risk. And this is done by removing the rate of return on the risk-free, such as treasury bond, from the expected rate of return. The expected rate of return, which is the expected rate of return minus risk-free all over, divided by what? Investment standard deviation. Investment standard deviation. And this serves as an indicator of whether an investment return is due to wise investing or due to assumption of excess risk. The variation of this is what is known as Sortino ratio. The variation of SAP ratio is what? Is Sortino ratio. And Sortino ratio removes the effect of upward price movement on the standard deviation to focus on the distribution of returns that are below the target or below the required return. Those ones that are below the what? That are below the mean value. So the Sortino ratio replaces the risk-free with required rate or required return in the numerator of the formula. Instead of risk-free, it's substituted with what? Required rate of return, making the formula the return on portfolio less the required return. So it will now be return on portfolio minus required return divided by the target or division of return below the target or required return. So division of target, the required return is the mean. Those ones that are below the mean is what the Sortino put in the denominator. Let me come again. I said Sortino try to replace the risk-free with the required rate of return. Understand? So this is required rate of return, and this is risk portfolio. Let me adjust this one. This is required rate of return, and this is risk-free. And this one now, it replaces risk-free with required rate of return and put portfolio return minus required rate of return from the stock, all divided by the distribution of returns below the target or required rate of return. Another variation of SAP is Traynor ratio. We have Traynor ratio that uses a portfolio beta or correlation of the portfolio as with the rest of the market. So beta is a measure of investment volatility and risk as compared with the overall market. So the goal of Traynor ratio is to determine whether an investor is being compensated for taking additional risk above the inherent risk in the market. So the Traynor formula is the return of the portfolio